Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklow.
And I'm Alex Collins.
And on today's episode, we're going to be talking about volatility over the last 2 days. Today's August 5th. And then this past Friday, the market has taken a bit of a dive, and it's all over the news, right? Like people are beginning to get worried. And that has brought up really today's conversation around, okay, this volatility that we face, is it a friend or is it a foe? So we're going to discuss both sides of that because it's both. And so,
Absolutely.
but before we dive into it today, Mr. Collins, what are you drinking today?
Today I am drinking Kona Big Wave. So it's a great summer beer. Always makes me think of getting away to Hawaii, and it's just kind of a fun beer.
Fun fact for you: I found this out on my last Hawaii trip. Um, the cans, when they have the ridges at the top, there's three ridges at the top. So raise the can there. So where you would put your mouth to drink it, that upper part, if it's actually brewed in Kona at the brewery in Hawaii, it will have three ridges on the
Hmm,
top there. And if it doesn't have the ridges, it was brewed here on the mainland.
that's crazy.
So just quick little knowledge fact for you for the good old Kona Brewery. I love Kona Brewery, by the way. I'm drinking, by the way, from Valley House, Hometown Hefeweizen. So second week in a row, sticking with the Hef. It's a solid one. It's 5.1 alcohol by volume. But yeah, it's a solid one in my opinion. So
Man, it's a great beer. Um, it's a perfect summer beer. It's nice and light. It's not the normal like IPA or anything like that we normally drink. So this is just it's a nice change and keep it light and refreshing during the summer.
yep, love it. All right, let's dive into today. So right today, Monday the 5th, I'm looking at the market like live. It's 1228. Right, the S&P is down 3% right now for today, and I think it was down. I want to say like 2%, maybe even 3% last Friday. And people are getting concerned, and they make this. Some people will make decisions right now because they get fearful. And this always brings up the conversation around, okay, how are you setting yourself up when it comes to managing volatility?
When there's multiple different conversations to have. I mean, the first one is between Thursday and today. Do we really think that the market as a whole 20 years from now is going to be 5% lower today versus last Thursday? That far out in the future? I mean, like
It's
these short
impossible to
term.
know. History
Yeah.
says otherwise. History will tell us that probably not. But this is the great thing about volatility in your pre-retirement, right in your working years. And I think this is something to remind yourself with is the volatility is really, if there wasn't any volatility, we wouldn't have the opportunity for a higher rate of return, right? That volatility creates the opportunity for these double digit rates of return years. Now, do we get that every single year? Of course not. But the volatility is what creates that, right? And that's why it's a friend in your pre-retirement or your working years.
Well, in addition to that, during our working years, when you're putting money in, we just get to buy more shares with the dollars that we put in.
Yep.
And so, again, from that standpoint, it can work in our favor and be our ally as opposed to our foe. Now, the more dollars that we have invested, the less that works in our favor. So, for folks that are early in their accumulation years, volatility, like there's doesn't matter whether it's up or down, like ultimately it's a good thing in general. Whereas when we have more dollars invested, now we care a lot more about volatility. And when we get to retirement and we start actually pulling funds from our retirement accounts from the market to live on, now it becomes an even bigger deal because whatever dollars we pull out, if the market's down, we do not get the opportunity to wait for those dollars to come back when the market when and I should say if the market comes back. Now, in all but like one or two examples, like, I don't know, the Dutch tulip market, Beanie Babies, and maybe a couple other things, the market has always come back. And I'm not trying to compare the stock market to tulips or Beanie Babies. It's just a couple of the historical examples.
Yeah, so let's dive into, so again, in your working years, right, it can be to your favor, right? When you get closer to retirement, this is where, and again, Alex and I have spoken into this piece a lot. Like, you need to be looking at your entire balance sheet so that you're not reliant upon the market to either make or break you in any stage of your life, right? But as we're getting closer to retirement, and when we get to retirement and we start to pull money out, that's when volatility can really become a foe. And so, Alex, if you want to bring up the sequence of return calculator. So the risk is, from the volatility standpoint, is a risk called sequence of return. And I think this sequence of return risk, I've seen it out there, um, almost where it's there to scare people to make different decisions, and that's not the purpose of hopefully it's not the purpose of what we're about to show you. It's not about scaring you. It's more about giving you the knowledge of how volatility works so that you can set up your balance sheet and your investment portfolio to the degree that it should be, so that the volatility doesn't make or break you in any given stage of your life.
Yeah. So in this example, we've got a 30-year study period. We're starting out with $0. We're making annual payments of $50,000 a year. We're increasing those payments at 3% a year. We've just got a 6% average rate of return. So then we're looking at what the sequence is over a 5-year time period or a 10-year time period. This is an example using 5 years. We're going to start out with having the worst years first and then the best years at the end. And like, sorry, when we accumulate, those are positive dollars going in. What you can see is like, okay, on a fixed rate of return at the end of our time period here, we'd have 5.8, almost $6 million built up. Well, given the worst years happening early on, it actually helps us and we get a little bit of a boost. We're actually a little bit up over 6 million at 6.125 or 6.15. And so the fact that we have bad years early on and are able to purchase more shares winds up helping us when we don't have much in the way of assets to begin with. And we compare that to, say, having the best years early on, the reverse. Now we only wind up at 4.7 because we've got the bad years when we've got the most amount of dollars there. Now, that is the accumulation side that Ryan was talking about, where volatility oftentimes can be our friend. Now, it depends on what the sequence is, whether it is, random or whether it is fixed, whether we have the worst years early on, whether we have the best years early on. Ultimately, we don't get to control or pick when these things occur. And so as a result, the existence of that volatility offers us the ability to go get those potentially double-digit rates of return, as shown here by the positive 15, positive 16, and positive 11. And that oftentimes will dramatically help offset these negative years like negative 11, negative 1. Now, when we shift over and start talking about pulling money out of a portfolio, if we've got $5 million and we're pulling out $50,000 a year and increasing that over time, when we start looking at the fixed rate of return, like, okay, great, we're still doing just fine. We actually wind up growing money in that example. When we start going ahead and messing with stuff, if we've got the worst possible sequence of returns, you can see now instead of ending up with 22 million, we only ended up with 18. And on a $5 million portfolio, that might be a little bit extreme. I mean, we'd actually probably take more income if we change this to, let's just, we'll leave that at 5 million and make this 250 instead of,
The
50.
Yep.
And so now you can see like, okay, hey, on a fixed, in our fixed example, if we got a fixed 6% rate of return, we just barely wind up running out of money over our 30-year time period. And if we go ahead and have the worst rates of return occur first, we wind up with a very different story. We wind up not negative $500,000, but negative $6 million, and we run out of money way the heck back here in between year 22 and year 23. If we wind up with the best possible sequence of returns over this time period, we wind up eking out a little bit of positive gain at 1.1. But you can see, like, we've still destroyed 80% of the value. This is taking a 5% distribution. It's one of the reasons why we use the 4% rule as opposed to pulling out more income. And you can see, we don't get to choose whether we have the best sequence of returns or the worst sequence of returns. And that is going to matter dramatically as far as like what the outcome comes to be when we start taking a look at retirement distribution.
Yeah, the key, and when we get to retirement, when you're pulling money out of a portfolio that is in the market and it's a down year, you're not only pulling the money out that you need for an income, but you're also losing a lot more because the portfolio is also down that year, right? So if you start at $5 million and it's down, negative 10%, right? So it's $50,000 in that you're down. And if you took out 250, you actually lost 300,000 that first year.
What? No, I mean, down 10% on a $5 million portfolio, you're down $500,000.
Sorry, $500,000. Math, sorry.
Math in the moment
way
is
off.
challenging at times.
So again, you're down $500,000 plus a 250, so you're down 750 in year one.
Right.
That's a huge piece, and that's where this can become your foe. Right now, again, setting up your balance sheet, setting up your portfolio, diversification, not all of your money being in the market, having assets outside of the market that aren't correlated to the market, having assets inside of the market. These are key so that you don't have this huge risk on your balance sheet. You can lower this risk and maybe even capitalize on it depending on how you set yourself up.
Right. Well, and making sure that like as we get closer and closer to retirement, that we're creating a retirement income distribution plan. We're stress testing the plan in the event that we have bad years early on in retirement. We've got ways of going ahead and digging in and getting through bad years, especially if they happen early in retirement. Those are some of the key success factors to being able to retire properly, is making sure that we've done all of our due diligence and done all of the homework ahead of time. And when we talk about, like, oftentimes the flip side of talking about volatility is talking about diversification. And so it's we're going to play a game called Find the Pattern, where if we start out with $1 million, and Ryan, let's just go ahead and do this live. What year do you want to go ahead and start looking at?
1980, my birth year.
Okay, 1980. Let's just use a 10-year study period. And so the way in which this works is that Ryan, who's an investment professional, looking at historical data where, in theory, we all know exactly what happened back in the 80s. So Ryan gets to pick and choose whether, like, which category we invest in: short-term U.S. debt, long-term U.S. debt, U.S. large stocks, U.S. small stocks, U.S. large value, U.S. small value, international large stocks, or international value. We got to put all of our $1 million in one category every year. We're going to do this for 10 years, and we'll see how well Ryan does. We didn't practice this, so it'll be interesting to see like where Ryan does. Now, bear in mind, this is, again, historical data, and Ryan is an investment professional. Ryan, where do you want to put the money?
Sure. So it's the 80s. Let's choose government bonds to start year one.
Okay. Long-term government bonds or short-term bonds?
Let's go long-term.
Okay. So lost 3%, and we missed out on U.S. small stocks at 40% that year. 81.
81. Let's go with bonds again.
U.S. Long.
Sure.
Positive, but we missed out on U.S. small value at 17.
I'm just
82.
going to pick bonds the whole time.
Okay. Up 40%, just barely missed US small value being up a couple basis points higher. Picking bonds again, positive rate of return, but again, we lost out on almost a 40% rate of return. If we go bonds again, 15 and a half, just slightly behind US large value. Bonds again, up 30%, missed out on a 56 over here in large international large. 24% in 86, missed out on 70% rate of return in international. 87 lost a little bit, missed out on international value at 34, almost 35. Bonds did almost 10%, missed out on another 38 over in international value. And 1989, up 18%, missed out on US stocks. So in this example, we were 0 for 10. But when we go ahead and click worst results, there were only 2 times where the worst result possible was picked. If we go ahead and click best results, there's really no pattern here. We've got all of the various different stock categories had at least 1 year in which they were the best, and it doesn't seem to be any discernible pattern between like where and when the different stocks did the best.
And the whole purpose of this calculator is essentially there's no rhyme or there's no way to pick which asset class is going to be the best asset class in any given year, right? It's just impossible. Here we're looking at historic stuff. Now I just kept it easy and just stuck with bonds here, just because most people think of the 80s and they think of bonds, right? And look where all the best asset classes were. It's all over the place. Bonds actually was never once it, yet that's a key ingredient to many people. Like that's a key asset class that most people bring up in the 80s. And
Right.
when we look at this, okay, so if it's impossible to know which one's going to be the best asset class, why is it that oftentimes when we are looking at and we're analyzing people's portfolios, right now, a lot of people's money is in the U.S. large stock category, which is the S&P 500.
Mm-hmm.
Why is that? Well, it's because A, that's what most of the media heads talk about. B, it's done rather well as of late. Now, has it been the best asset class in every year? No. Right? But how much of our money is sitting in this one particular asset class and how are we missing out? And then on top of that, take it when it has a downturn. If the bulk of your money, and by bulk, I mean 30%, 40% is sitting in like a US large stock portfolio, that means 30 or 40% of your portfolio is also going down. So you have to have diversification. This is what we mean by diversification, rather than chasing what we call chasing return.
Well, in this example, I mean, Ryan more than tripled his money over a 10-year time period. Depending upon what type of time period we look at, if we looked at, say, the 2000s and used just the S&P 500, we actually would have lost money over that time period. Our $1 million would have shrank to almost 900,000. And there were a couple really bad years where you'd have to really, like, if you were taking distributions from this money, you're down 37% in 1 year and you're still taking an income stream. I mean, that's just brutal to a portfolio.
When I think a lot of people, when they hear diversification, I think they look at it and go, okay, all my money's not in the S&P 500. I think that's what some people might be hearing right now. And we're not saying all of your money is in the S&P 500, although there might be some of you. I have no idea. What we do know is oftentimes when we're looking at our clients' 401ks, they're picking maybe a target date fund. And when we analyze what that target date fund is invested in, oftentimes it's 30% of their money is sitting right here in the US large stock or higher
or more.
Right? And we're not saying that 30% is too high or too low. We're just explaining what's really at risk here. And so we want to make sure we're diversified across different asset classes because, going back to the 80s and that international large value hitting huge numbers, 56%, I think is what one of the numbers was that you put out there. How many people realize that in the 80s, one year, the international large class hit 56%.
There's one year where it hit 70. Well, almost 70.
85 and 86. So how many of you listening knew that? Like, I didn't even know that. So you miss out on huge returns. So that's why we diversify. So maybe you can capture some of that return and not be all in on one particular asset class. Take that to a step further, Alex. I know I've said it. We've said it several times in this episode already. This is just a portfolio, like one maybe individual account. I'm talking when we take this broader to the balance sheet. Yeah. How do you currently look? And oftentimes when we're sitting down with people, no matter the income levels that they've got, 7 figures down to, 5 figures, it's normally very little in cash and all in the stock, some stock bond portfolio. That's it. Like, that's their balance sheet.
Yeah. And this is obviously, Bear and Wilma Down are a fictitious couple, but the design of this was to try and make it maybe somewhat comparable to our clients that are in their, early 30s, as an example of a portfolio, where we've got, and this is obviously a few years old. We've been using this example for quite a while now, but, $1.1 million of value in their home, $350,000 of stock market, bond market type investments, mostly in retirement accounts, a little bit in investments, and a little bit in cash. And like, that's very typical of what we've seen over the last 3 to 5 years. Is very little in the way of cash, and lots in the way of retirement and home equity.
Yeah, so having a diversified balance sheet is just as important. So today's takeaway is really discussing volatility, right? It's a friend and a foe. And you can mitigate the foe aspect of volatility by setting your balance sheet up and your portfolio up appropriately, which is a key piece that I think most people really kind of overlook. They think of the word diversification in the individual accounts. And it's like, well, I'm not all in Apple, so I'm diversified.
Right.
Right. So.
Well, and like there have been a few times where like I've sat down with folks and they're like, oh, I'm totally diversified. Okay, great. What do you have? Well, I've got Apple and Microsoft and Google and, Facebook, and like, okay, got it. So you've got a whole bunch of stuff in tech. Like a handful of large tech based here in the US. Yeah. Well, okay. I understand why you think that that's diversified, and that is not, when investment professionals talk about diversification, that is not what they're talking about. We want to see, different industries, different countries, different sizes, like value versus growth. I mean, there's a boatload of other factors that we want to try and build into it. Typically the portfolios that you and I create, our goal is to go ahead and not have more than 1% in any one individual company. The S&P 500, about a third of the portfolio is invested in the 6 largest tech companies, or at least it was in prior to the most recent downturn. Tech's been hit a little bit harder over the last week or so. So I'll be curious to see how the numbers shake out here as this current decline dissipates.
Yeah, I'm not saying this to demean anyone in their portfolio. A lot of times it's there, you invest in what you know. Mm-hmm. Right. Or you invest in maybe what your 401k allows you to invest in, right? You don't look at you maybe don't have many options. You never thought about, putting money outside of your 401k because you never had that type of conversation. Right. So that's really the area of advice that a financial advisor should be giving. Is it's not just investment only related.
Yeah. And that brings us to our question today. Our question today is, basically the topic of the episode. Do you view volatility as a friend, as a foe, as both, or as neither? So head on over to, go ahead.
So head on over to beerandmoney.net. That's my line, Alex. You should know this. Come on. Head over to beerandmoney.net. At the top of the page is a contact us spot. And we'd love for you to reach out to us with any questions or anything that you got out of today's episode. you did get anything out of today's episode, share it with a friend, share it with your coworkers, share it with your family, because I'm guessing if you got something out of it, they might as well too, which is the whole purpose of us doing this podcast, is to help you with money decisions so you can actually spend the time with your family and enjoy life. As always, we hope this episode was valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Pinpoint number 2024-180319. Expiration August 2026.